Percival Stanion is head of asset allocation at Barings Asset Management, which has over £32 billion of assets under management. Joins me live now from central London. Percival, thank you very much indeed for speaking to us. I want to actually start by asking you about that inflation data from China accelerating the fastest pace in nearly 3 years. Are you concerned about what this could mean for global growth?
Well, we've been concerned about inflationary pressures not coming under control in China and other emerging market countries for some time now. There's been a general expectation that they've dropped back, and we've been quite sceptical of that, and I'm glad we've taken that stance given what's happened in the last few months.
And what do you need to see in order to alleviate your concerns with respect to overheating inflation in emerging markets, countries like China? What do you want to see?
Well, we want to see a bit more dramatic policy action. We think some of the authorities have been slow to raise interest rates and curtail activity. They've relied on some administrative measures in some countries, including China, which have not really been very effective and have help just cover up the problem on a short-term basis without getting to grips with it. So we'd like to see some more dramatic action.
That's interesting, Percival, because also many analysts and economists saying, well, they have been increasing lending requirements for banks, they have been raising rates, and actually, I suppose this latest data shows that perhaps that hasn't been as effective as one would hope.
No, not at all. We've had disappointments now for several months running, and perhaps this is a signal for them to do something a bit more dramatic.
We have seen, just to speak more generally about the sell-off that we've seen in global financial markets, it has extended to losses in emerging markets. Are you somewhat surprised that those assets weren't perhaps more insulated?
Not really. They do enjoy better long-term secular growth prospects, but the reality is that these are quite shallow markets. They don't have highly developed local domestic investor bases, so they tend to be dominated by retail flows and by foreign flows. And it's a simple knee-jerk response to take risk off. When you see problems emerging in big countries like America, you'll see knee-jerk selling of emerging markets, which later in the year we think that's going to provide us with some good buying opportunities.
Later on in the year, does that mean that they have further to fall?
Well, given the way markets are behaving over the last few days, later in the year could be later today or later this week or maybe next week. The speed of adjustment is occurring very rapidly. So we had been thinking this would be a process of some weeks or months, but it's all taking place very swiftly.
And how is any of this going to impact your exposure to emerging markets in general?
We've been quite low in emerging market equities, so we've been expecting some turbulence in markets for some months. We came into this very conservatively positioned, so we're looking at this to provide us with opportunities to get back into some of these areas.
So if you saw this turbulence, this correction coming, if you like, were you already making changes in your portfolio and your general sort of asset allocation then ahead of this sell-off?
We were cutting equities and other risk exposures three months ago, building up exposures in gold bullion, in certain government bonds, including places like Australia, and so making the portfolios more resilient.
So you're continuing to invest in gold, and I'm just wondering, do you think that higher gold prices might have any impact on the appetite for US Treasuries?
Gold is seen as the ultimate safe haven at the moment, particularly in an environment where any type of emergency response now of policymakers in the West is probably going to include some type of money printing process to try and stabilise markets, and that's very likely to benefit gold.
I'm curious to get your thoughts about oil as well, because we're seeing it heading now for the biggest two-day drop, I should say, in more than 2 years. And, many analysts have been telling me, well, the fundamentals of supply and demand haven't changed because you still have strong demand from emerging markets and you still have supply problems potentially from Middle East tensions and Libyan oil effectively coming off the market. So I'm just wondering if you think we could see another price rally.
Well, I have to say I think that's unlikely in the short term, unless we have some other type of major disruption to supply in the Middle East. I think that the decreasing or the likely diminution of world activity is going to see oil come under further downward pressure in the next few weeks and months.
And just a very quick one, Percival, on German bunds. You're saying that they are amongst the safest, well, they are, of course, amongst the safest assets in Europe right now, goes without saying, but you're saying these low yields unsustainable?
Long term, yes. We're not very keen on bunds. We think that ultimately Germany will get roped into, or very likely to be roped into, underwriting other European bond markets, and so ultimately German bond ratings will also come under pressure.
Interesting. Thank you very much, indeed, Percival Stanion. Appreciate your time, Head of Asset Allocation at Barings Asset Management.